everyone, welcome back to Corporate Decoder, the place where we figure out what's really going on in the business world. Today we are diving into American Express's latest quarterly report. It is the kind of report that is so exciting you will feel like you are flying first class, except you're actually just sitting on your couch probably. Let's get into it. This report gives us a snapshot of how Amex performed in the first 3 months of 2025. We are going to break down the key numbers, see where they are making money and what challenges they might be facing. Basically, is your Amex card still getting them a boatload of cash? Scroll March 31, 2025 numerics for the period ending March 31, 2025. They are comparing it to the same time last year. This helps investors and regulators see where the company is improving and where it may be falling short, or if it is just treading water. Let's cut to what everyone wants to know, the money. Amex reported total revenues after taking out interest expenses of about $17 billion. That is up about 7% from last year. Remember that this isn't pure profit, it's what's left after paying for the cost of borrowing money. Next is provisions for credit losses, which are at $1.15 billion. This is actually a decrease from last year's $1.2069 billion. This is an accounting estimate of money Amex expects to lose from people not paying their bills. The decrease could mean they expect people to pay their debts, or it could mean they're changing the way they estimate these losses. Total expenses are up. They spent nearly $12.50 billion, a 10% increase. Expense numbers going up faster than revenues can be a sign that the company is losing efficiency. Finally, earnings per share, which is a key number, came in at $3.64. That's a 9% jump, showing some solid growth in profitability for each share you might own. A useful thing to know, outstanding at April 11, 2025 were just over 700 million shares. Keep that number in mind if you are calculating ratios. A quick look at some key metrics. The net write-off rate, that is how much they charged off in loans, remains steady at 2.4%. Delinquency rates also remain at 1.3%. Both of these figures staying consistent can be a good thing for Amex, but they are also numbers that you want to keep an eye on. Growth in billed business also grew 6%. That is the amount of charges on their cards. Their discount revenue as a percentage of billed business actually dropped slightly to 26%. Looking at the different segments, US consumer services saw a revenue increase of 10%. Commercial services, however, only saw a 2% increase. International card services had the largest growth rate at 9%. Global merchant and network services actually went down 3%. A big metric to look at for financial companies is their capital ratio. Here, Common Equity Tier 1 is at 10.7%. These numbers are regulatory requirements and often a benchmark for how conservative a financial institution wants to be. As a quick note on expenses, card member rewards are costing Amex big. They are up 16%. That means those points, miles, and cashback rewards that get you to spend are also costing them more. The membership rewards ultimate redemption rate, or EUR for current program participants, was 96%. In essence, it means that rewards are popular, with almost everyone using their points. Salaries and benefits are pretty stable, up only 1%. A company of this size that wants to grow will probably want that to go up at least a little bit, but also not too much. The company's stress capital buffer, or SCB, is set at 2.5% and will be that way until October of 2025. During the first quarter, they issued a few billion in debt. You can see the rates listed here, which can move up and down with the market. As of the report, Moody's rates American Express at A2. S&P has them at A and Fitch has them at A. All are considered investment grade. A large portion of their deposits are insured by the FDIC. This is extremely important as customers are much less likely to flee a bank if they know their deposits are safe, and that is the job of the FDIC. Overall, their cash flow from operations was strong. As a financial company, they are subject to a range of supervision and regulation, including enhanced prudential standards. Surcharging could also have a material adverse effect. This happens when merchants pass on the cost of card fees to the customer and dissuade people from using their cards. The company also identifies increasing competition from emerging technologies as a major risk. Finally, as is standard, there is a note on potential dealings with Iran. The company voluntarily reported these deals to the US Treasury. That was the report. Let's wrap this up. Amex's first quarter shows a company that is doing all right with solid revenue growth and stable credit quality. However, expenses are rising faster than revenue and are something to keep an eye on. Key strengths include a strong brand recognition, customer loyalty and solid growth in international markets. One-entable risks include CAMTIA, increasing competition regulation CAPIA, regulation cow and expense management. Overall, American Express seems to be moving in the right direction and is handling a complex environment reasonably well. However, if you are deciding whether to invest in this company, you will definitely want to monitor those expenses and watch out for big changes in the regulatory landscape. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe. What other companies would you like us to decode next? Let us know in the comments. See you in the next one.